Let's go now to our friend Beimnet, a BB from Galaxy Trading. As always, my friend, great to have you on the show.
Thanks for having me. How we doing?
We're good, man. And it's been a little bit of an interesting time, mostly because of the regulatory stuff that's been coming down in these news events for traders. But before we get to that, let's talk about data this week in economic data that we've seen. What do we have?
It was spectacular. So we started this week on Tuesday with inflation data.
CPI.
Yes,
Yep.
CPI. It came in at 0.5% month on month for headline CPI, which is a super robust reading.
So that's 0.5% increase
month on month. Yeah. So if you multiply that by 12,
this is January
that
data.
gets you,
So January over December.
Correct.
Wow.
So
that's
it's
significant
really robust. Yeah. And a lot of it, or a good amount of it, was driven by housing, or owner's equivalent rent, which printed a 0.8 month on month.
Still going up?
Still going up, but we know that is sort of a lagged indicator. And in theory, given some of the higher frequency data points we look at, we do expect that to come down over time. Mm-hmm. But nonetheless, with the U.S. and incredibly restrictive monetary policy, we're still having inflation that's very robust.
Wow.
Right? You did have pockets of weaknesses in some medical services, like airline fares and things of that nature. So I think the narrative of inflation still big picture come on the way down, that narrative is still in place in the market. However, you did see a meaningful repricing of the interest rate curve after the CPI number. So right now, you have terminal rates pricing in about 525 basis points, and you priced out a lot of the cuts that were baked into the market for the back half of this year and early next year. You've had you went from pricing in at the dead lows about 170 basis points of cuts or around there to 110 now. So 60, 70 basis points of cuts that got priced out of the market as a function of how strong this inflation data was. In addition to that, you had retail sales this morning surprise higher. We had a 3% growth month on month in retail sales. And it was a very strong report, and that just added further momentum behind the sell-off you've had in fixed income. And now you're looking at bond yields that are sitting super close to the highs. Dollar has rallied a lot as well. Things like dollar yen are through 134. Euro dollar looks like it's going a lot lower, breaking 107 potentially. So you've had U.S. yields move higher. That's caused a rally in the dollar as well as the rate differential starts to go in favor of the U.S. And I think these are trends that can potentially continue, but it does seem like you've moved a lot very quickly. Mm-hmm. Just to think about it, you had the insane 500,000 jobs print 2 Fridays ago, right? So we know that employment's really strong, and now we know that inflation's really strong, and now we know the consumer is spending a lot as well.
Yeah.
And so you've had and the Fed speak's been hawkish, so there's a lot of hawkish stuff priced into the fixed income world and the FX world. And it's really interesting to think about in the context of equity markets and crypto markets.
Yeah.
Because if you asked me 6 months ago if we had a huge sell-off in fixed income and a huge rally in the dollar, I'd tell you stocks are probably down 5 to 10%. But really, stocks are barely off the highs. The S&P, as of this recording, is, I would guess, 4140, right? And the high has been 4190 or 4200.
In this period here.
So you're still sitting at the dead highs in stocks. The earnings weren't that bad. The January consumption figures that you've seen in the high frequency stuff tells you that U.S. consumer is totally fine. And so it looks like you're in a period where inflation's kind of cooling a little bit. The labor market's just fine. As in, basically the way to think about it is you went from soft landing in the market to no landing. It's just everything's fine. And so, I'm still constructive on risk assets.
Yeah.
And, if you look at crypto, you basically had a ton of regulations, headlines, and speculation thrown at it. And Bitcoin went from a high of 24,000 to 21,000. Sorry,
yeah,
21,500.
Yeah.
Right, a 10% correction from the highs.
Practically, I mean, you can see the block clock over my shoulder. We're practically at 23,000 again.
Yes.
Very resilient.
It's as if like one of the most powerful regulators didn't just come down on crypto. You couldn't even tell by the price action.
And we're going to talk a little bit more about
including
that,
the alts. I mean, they've just
it's crazy
gone on well.
So, but okay, let's take a step back here for a second because when I hear. What I hear is that inflation, it's maybe meekly cooling. It's barely cooling.
It's cooling.
Yeah, but like it's still strong. They're not winning the fight against inflation right now.
They're not.
They're not losing it, but they're sort of in a stalemate with it. And right, that's the whole thing. The dual mandate from the Fed is to maintain employment and keep inflation down.
Keep price stability.
Keep price stability. Okay.
Yes.
Which inflation is not stability of prices.
Yeah.
Right?
Yeah.
But yes, okay, appreciate that. And so they're not currently keeping price stability, really, but employment looks good. But the whole thing was a lot of people thought to get inflation down, you were going to have to damage the employment market, and that isn't happening.
Yeah.
But inflation's not really cool. It doesn't appear to be accelerating.
Correct.
But it's not really declining much.
Yes. I think those are
it's
all,
sort of like,
all fair points.
Yeah, so we're not really like, they haven't solved it.
Yeah. Well, here's what it looks like right now. Basically, it looks like the U.S. economy can handle significantly high interest rates just fine. People used to think that if you took interest rates to like 5% plus, that means recession, like slowdown in growth, consumptions, and all of these things. But realistically, like we've been talking about this all year, because of the structural setup in the U.S., the economy is a lot more resilient than it's ever been.
So we're talking about like what, technological innovation?
No, well, just think about mortgages, for example, right? Everybody took a fixed mortgage at 3%.
Right. So they can handle the higher rates because they're not even paying them.
They're not even paying them. Correct, right? Relative to the rest of the developed world, the U.S. has much higher percentage of
fixed rate
mortgages relative to floating rate. So that's a huge structural thing you have going. 2, what did we just go through because of COVID? We literally deglobalized. We took our manufacturing from offshore and brought it onshore. What did that do? That brought a ton of new jobs over into the U.S. economy.
Makes sense. While you have some inflation, you got to pay more for those domestically produced goods. And we didn't bring everything over, but a lot did. A lot of it
happened, right? And you already had a structurally tight labor market, and so you added more jobs to a tight labor market, and home asset prices have come off, but they haven't come off that much. You also had a huge savings base that was built up from stimulus check after stimulus check, PPP loan after PPP loan, and forgiveness, student loan forgiveness, right? The world just threw money at people for years. That just doesn't go away because you took interest rates up to 5% and have held them for
so the bottom line, though, we can sustain higher rates, but can we sustain this higher inflation, you think? Because I see some of the data, credit card debt.
Yes, it's back to trend.
Yeah, wouldn't it? Well, okay, but it's very high. The trend is up.
But just because credit cards are high doesn't mean that they can't go higher.
Is the consumer as safe and strong as the data suggests? Because aren't there a lot of people in debt and stuff like that?
There are tons of people in debt.
At some point, you think?
At some point, sure. But not now. It will break when people start losing jobs.
Yeah.
Right? As long as people still have jobs, the credit cycle can
because they keep making money.
They keep making money and paying or just paying down some of it. Paying down some of it.
Yeah.
But what you're really supposed to pay attention to from like a high frequency data point or just like a health of the credit market standpoint is these credit card companies have to hold reserves versus like potential losses.
Yep.
Right? And you can look at like default rates on these credit card loans, right? Or like how many credit cards have been delinquent. Yeah. So one of the things that people look for, at the start of like a downturn is for these default rates to start going up, and they really haven't.
I see. So the total balances are high, but people are paying it off.
The delinquency rates are super low.
Wow, interesting.
So yeah, the U.S. economy is just fine. The U.S. consumer is just fine, and there's a lot of people that are positioned for shit not to be fine. And so there's plenty of folks that are way too defensively positioned.
Assuming that we don't hit this mythic recession that all of the doomers on Twitter and the perennial macro doomers have been calling for, right? And right now, from your standpoint, it doesn't look like that's imminent.
Correct. And then I just think about like for asset prices to go down, you need people to sell them. right? Like fundamentally, how does stuff go down in value? It goes down in value because people sell it.
Yeah.
Right? In stocks, what's happening? You have corporate buybacks, right? U.S. corporates are still on the bid. Like these big tech companies still have huge share repurchases. The energy companies are doing really great. They're not giving out dividends, they're buying back their shares. Right? Then you have like the U.S. retail community, right? U.S. retail, if everyone has a job and you're at historically low unemployment,
they got money to spend.
They got money to spend. And like point being, like I don't think U.S. retail is really selling stocks, and everyone I know is still contributing to their 401ks, et cetera.
Right.
And so there's just still tons of like buy pressure on stocks. And then all the shorts in the hedge fund world, in the tactical world, they got wiped out after in January, and everybody got squeezed. And that's why you saw all the garbage names in the S&P rip higher, right? So the shorter, like there's not enough incentive to short because like these short squeezes can be pretty dramatic. Sorry, I'm a little under the weather. And so like the question is then like who's there to like sell stocks? And there isn't like crazy IPO supply coming down the pipeline either. So you're left in the market that has marginal buy pressure from, you know, corporates that are on the bid for share repurchases, et cetera. You know, constant 401k buying, although that's not really that much. And retail's not really a seller of stocks either. They're probably relatively underweight as well. So I just see risk drifting higher. And in my head, like there's no reason why the S&P can't trade at like a 21 multiple instead of like a 19 multiple. What does that mean? At $225 of EPS, it means the S&P could be at 4,500 before you fucking know it.
Yeah.
I think there's that risk. I also just, you know, given the slew of earnings we just had, like stuff's fine. So like if you were to go down, like where are you going down to? Like 4K, 3,900 just doesn't seem that attractive. And so in my head, the only way like we get a material sell off in like stock equities is if you just have a huge rotation from equities into bonds, which can happen. If bond yields go a lot higher, like it's possible.
Right.
And if they stay high for an insanely long period of time, you know, those risks grow as well. So, you know, I think right here, right now, I think it's
copacetic.
Things are fine. Things are fine.
And America looks strong.
And, you know, crypto doesn't seem to care about the regulatory
These attacks that have been happening, right?
Yeah.
We'll get into those with our guest today. Great conversation as always, my friend Beimnet, a BB from Galaxy Trading. Thanks so much.
Pleasure.